stick with the power space because that is essentially where there is, of course, continued momentum and visibility because we need more power capacity. I mean, we're falling short. Players are scrambling to put up capacity both on the thermal side and, of course, on the renewable side as well. So let's take this forward in some more details. We have Nikhil Nigania, Director, Senior Analyst at Bernstein, who is joining us. Nikhil, good to have you with us here. Thank you very much for your time. Prashant this side. You guys have initiated coverage on PFC and REC, Nikhil. Those are your notes, your coverage, Nikhil?
They are. So it's us along with our financials team. So we essentially look at them more as...
Yeah. Sorry, could you take us through, the rationale behind the coverage and, and what are you seeing here for these companies? Because stocks, first look, people will argue that they've done so well already. Maybe the best is behind. Valuations on a price-to-book basis look very stretched. How would you respond to all of that and sort of your thrust here on these two names?
Sure. So our thesis, it's a four-part thesis that we have on these two stocks. Number one is loan book growth. We think investors are underestimating the quantum of loan book growth these entities are likely to see. So if I give you simple numbers, for example, in India in the last 6 years, we added about 100 gigawatts of generation capacity. In the next 6 years, we think we'll be adding more than 300 gigawatts, a combination of both renewables and thermal. All of that will lead to more transmission and hence more capex across the power value chain. And these guys are the preferred lenders to that space. The second part of our thesis is a lower risk of NPAs in this area. So historically, these stocks have traded low loans given to thermal private plants where defaults have happened in the past. But if you look at the incremental loans they are giving are largely either government or private renewables. In renewables, it's much less. I mean, the probability of an NPA is much lower than what it is in a thermal plant. Given this a very shorter execution time, you can execute a renewable plant in a year or two. Hence, PPA is a condition precedent to disperse a loan. The third reason we like them is competition side as well. So earlier, renewable companies used to borrow in dollar bonds. But if you look at the spread between US and India 10-year GSEC, it's cheaper to borrow in rupees now than in dollars. Hence, rupee loans are preferred by renewable companies. And the fourth reason is reversion of provisions. So if you look at the power cycle, we have gone from shortage to surplus to shortage again, especially in the evening hours. So thermal plants are making good money. And hence, the distress assets in their book, we think they're likely to get resolved this year. So we could see provision reversal happen. So those are the four reasons we like them. See, repeat of the last year is unlikely, but we still see more room for re-rating. Hence, we have a positive view on the stocks.
Okay. So capacity, total capacity in the next 6 years, 2x of what was done in the last 6 years. Much shorter execution timeline for renewable projects, right? You're saying that rupee loans, so currency risk in that sense is lesser. And number 4, you're saying thermal plants are making a comeback. These are the four kind of four reasons on the back of which you're building this thesis. Now, just talk to us about the valuations here for PFC and REC and what should one be willing to pay for these companies?
Yeah, exactly. So if you look at these stocks, on an earnings multiple basis, they are still at 8 to 10x earnings multiple. So if you look at the historical range, that's about 1 standard deviation away from historical mean. So not too expensive that way compared to historical mean. And even on a book multiple basis, the target we have on both of these names implies a close to 1.5 to 2x of book value of FY25 ending, which we understand is higher than historical, but nothing like the last cycle peaks these stocks have seen. Hence, we see some more room for re-rating on them.
Okay, but just one follow-up there, right? I mean, if you look at a stock like, say, Power Finance Corporation, it has done nothing in the last 4 years. It only started to perform in 2023. I mean, in 2023, it was, I think, around 100 rupees, and now it's gone to 520. So one asks the question that although there may perhaps be more legs on the upside, but has a large part of the rally been missed by investors? Your thoughts?
No, I agree. The large part of the rally is behind us. So even the upside we see in these stocks as we have initiated on is about 20-25%. Nothing like the big rally we saw the last year. The rally last year, which was not just them, it was the entire power sector actually, was a turn in the entire power cycle, as I said, from going from surplus power to shortage, especially in the evening hours of the day, which is what led to that. So yeah, to your question, we can't repeat last year. but still more room for upside.
Okay. And in terms of earnings upside, right? I mean, you spoke about the potential, the loan growth potential, etc. But what are you factoring in? From this price, is there further earnings upgrades that you're looking at both in PFC and REC? If yes, what are your EPS estimates? What are your target prices?
Yeah. So from a loan book growth perspective, which is the key driver for earnings for them, we anticipate more than 15% loan book growth for each of them. So for REC, we have built in about 17-18% loan book growth for the coming 3 years. And in the case of PFC Standalone, we have built in a loan book growth of about 16% or so for the coming 3 years, which translates to an earnings CAGR of about 12-13% on both of them for this 3-year period, per se.
I got it. Nikhil, so let's look ahead, right? By the way, you have coverage on other power names as well? I mean, what's the coverage universe for you in power?
So we cover NTPC PowerGrid on the conventional side. Then we have some renewable names as well, which is Renew and Adani Green, and the power exchange IEX. So that's a broad coverage apart from these two names.
Okay, and you have a positive sort of view on most of these names?
So we are positive in terms of the stocks we like. Apart from PFC, REC, we like NTPC and PowerGrid. Both those names we have been positive for quite some time now. So yeah, so these are the 4 stocks where we are positive within our coverage on the power side.
All right. Now, in terms of policy push, right, is everything in place, or will we should we expect anything more? I mean, the budget is around the corner. What can the government do? I mean, are there any expectations at all, or is basically now about execution?
So on the budget front, I think maybe a couple of areas to look out for. Power is not super critical from a budget perspective, but 2-3 areas we are keeping an eye out for. One is the rooftop solar scheme, which the government announced. So that requires a big budgetary outlay. So we are waiting to see, what kind of outlay is planned for this year and how big a push that rooftop solar scheme sees. The second thing to watch out for in the budget would be the funds for the DISCOMs, the power DISCOMs, the RDSS scheme, which the government runs. Because DISCOMs, I mean, they have historically been the Achilles heel for both lenders, generators, everyone. So what kind of support they get. So those are the 2 areas we are watching out for on the budgetary side.
Okay, we'll leave it at that. Thanks a lot, Nikhil, for joining in and talking about the power sector. But just look at the